Obtaining a loan for a new construction for a commercial facility is one of the toughest loans to obtain. Today, we're going to be looking at how a bank is assessing you as a borrower through the lens of the bank. So how does the bank assess you as a borrower? The three main factors is, number one, you have how strong the ownership group is. Number two is how defined and detailed your business plan is. And number three is the skilled project team. By that, I mean how skilled is your construction management and architectural team? Can they deliver on time? Can they meet the budget? And can they deliver with the highest quality of standards? So let's go into the lens of the bank. Today, we'll be going over what is called passing the profit test. This is how a bank is assessing you as a borrower. So one formula that they use, especially when you're using your property as a collateral, is the finished facility worth more than the cost of the construction? Then you have your ownership group, and they're looking at, have you done these type of projects before? What is your historical success on projects that you're trying to obtain a loan on? And number three is your external team. They'll be assessing your construction and architectural team and seeing if they done these type of projects, and have they delivered on time, and have they met budgets on projects of that you're trying to obtain a loan for. Two main ratios that the bank is assessing you as a borrower is called loan to value ratio and loan to cost ratio. Loan to value ratio is basically the amount of money borrowed versus the value of the facility, and loan to cost ratio is amount of money borrowed versus the cost of the project. In today's financial market, most banks don't lend more than 75% of the total loan value, and in some projects, the threshold may be lower. So the lower loan to value or loan to cost ratio, the less risk your lender is taking, which means that you have to provide less as a collateral, or you may not have to provide personal guarantee. But in today's market, personal guarantees is almost a requirement nowadays. Now we'll be going over the collaterals that are typically required as a borrower. There are two main collaterals. Number one is the finished facility, and number two is the land. The finished facility is used in almost all loans, which means that if an owner defaults on a loan, the banks take over the finished facility and use it to pay off the debt. The land is also used as a collateral, and this may be a bigger portion of the collateral because as a lender, it is easier to sell or to lease than some of the other collaterals. Personal guarantee is something we discussed earlier, and now we'll go into a little bit more detail. In a personal guarantee, what you're doing is basically guaranteeing that if a project fails, that you'll be paying back the loan. So it is a very, very strong commitment and should be assessed carefully before you sign off on a personal guarantee. One of the other ratios that we did not discuss earlier that is used when a bank is assessing you as a borrower is called loan to size ratio. Now this is basically stating that the loan or the amount of the loan must equal the net worth of the ownership group. As a borrower, you are required to submit your assets and liabilities to the bank, and this is typically required on an annual basis. And personal guarantee can be joint or several, and also be capped at a certain amount. Thank you for watching our video today, and stay tuned for more educational content similar to what you watched today. Please like and subscribe to our page. Thank you.